Welcome to Small Business Signals. I'm going to tell you about a problem that has destroyed more promising businesses than bad products, weak marketing, or tough competition combined. It's the cash flow illusion, the dangerous gap between what your profit and loss statement says you've earned and what's actually sitting in your bank account. Today, we're bridging that gap with practical tools you can implement this week. Not theory, not generalities, but specific techniques that work. Here's a signal that should stop every small business owner in their tracks. According to the NFIB Small Business Index, cash flow ranks as the number 2 challenge for small businesses at 29%. That's second only to inflation at 31%. More owners lose sleep over cash than over finding customers or managing employees. And here's what makes this so dangerous. 71% of small business owners reported improved financial performance in 2025 versus 2024. Profits are up, yet cash flow remains a top concern. Something doesn't add up there, right? Businesses making more money than ever, still worried about cash. That contradiction is exactly what we're going to decode today. Let's start with the fundamental problem. Your profit and loss statement, your P&L, is essentially lying to you, not maliciously, but structurally. Here's how. Accounting rules say you recognize revenue when you earn it, the moment you send an invoice, not when payment arrives in your account. So your books might show you earned $50,000 last month, but if your customers haven't paid yet, that $50,000 exists only on paper. Meanwhile, your landlord, your payroll provider, your utility company, they don't care about your receivables. They want cash, and they want it on schedule. The numbers make this concrete. According to industry research, the average small business waits 28 to 34 days to get paid on invoices. But expenses like payroll, rent, and utilities, those are due within 0 to 15 days. Some are due immediately. Think about that math. You're waiting a month to get paid, but your obligations come due in half that time or less. That's a structural timing gap that has nothing to do with profitability. This is why businesses that look perfectly healthy on paper suddenly can't make payroll. They've got the revenue. They've got the profits. They just don't have the cash when they need it. As one financial advisory firm put it, many small business owners confuse profit with cash in the bank. The profit and loss statement may look strong, but the checking account tells a different story. So what's the solution? How do you see the cash crisis coming before it arrives? The answer is something called a 13-week rolling cash forecast. According to CFO advisory experts, a 13-week rolling forecast provides a real-time snapshot of your cash position by continuously updating projections as each week ends. Why 13 weeks? Because it's roughly 90 days, long enough to see problems forming, short enough to maintain accuracy. One advisor described it this way: a 90-day cash flow forecast clears the fog. It shifts your focus forward, allowing you to see problems forming in advance, instead of reacting to them after the damage is done. Here's how the 13-week forecast works in practice. Every Monday morning, you update it. You add a new week at the end and remove the week that just passed. You list every expected inflow for each week, invoice payments you expect to receive, contract payments scheduled to arrive, cash sales if you have them. Then you list every expected outflow, payroll dates, rent due dates, vendor payments, subscription renewals, quarterly tax estimates, everything you know is coming. The math is simple for each week. Starting cash plus expected inflows minus expected outflows equals ending cash. That ending cash becomes next week's starting cash. Run that calculation out 13 weeks, and suddenly you can see exactly when you'll be flush and exactly when you'll be tight. No surprises. There's another metric that makes this even more powerful: your cash conversion cycle. This measures the time between when you pay your suppliers and when you receive payment from your customers. The formula is days inventory outstanding plus days sales outstanding minus days payable outstanding equals your cash gap in days. If that number is positive, and for most small businesses it is, you've got a gap where cash is tied up before it comes back to you. According to NAV's cash flow guide, optimizing this cycle can create a form of internal financing, money you generate from your own operations rather than borrowing. Now let's talk about the tactics. Because knowing you have a cash gap is only useful if you can do something about it. The first lever you can pull is on the income side, getting paid faster. One of the most effective and least used tools is automated invoice reminders. Most accounting software, QuickBooks, FreshBooks, Xero, includes this feature at no extra cost. Set up reminders at 7 days before due, at the due date, at 7 days past due, and at 14 days past due. These gentle nudges tend to reduce collection time significantly without damaging relationships. And here's something most business owners never consider. You can actually negotiate payment terms with your vendors. I know. It feels awkward, but vendors expect this. Even extending from net 15 to net 30 on your largest vendor can significantly improve your cash position. That's 15 extra days to collect from your customers before you have to pay out. Businesses that consistently maintain healthy cash flow treat it as an ongoing discipline rather than a one-time problem to solve. That distinction matters. This is about building habits, not running a fire drill. Update your forecast every week. Review your cash conversion cycle every month. Build reserves during strong periods to buffer the weak ones. And here's a quick win many people miss. Review your subscription and recurring charges quarterly. You likely have tools you're paying for that you no longer use. Take 30 minutes this quarter to audit every automatic charge. Cancel the ones you don't need. For the ones you keep, check if annual billing offers a discount over monthly. Now I want to address something you might be wondering. What if the gap is too big to close with these tactics? What if you need faster cash right now? There's ongoing debate in the financial advisory world about this. Some recommend offering early payment discounts, say 2% off for payment within 10 days instead of 30. Others argue this erodes your margins unnecessarily. A 2% discount to get paid 20 days early effectively costs you 36% annually if you do the math. Invoice factoring is another option, selling your receivables to a third party for immediate cash. But factoring companies often charge fees that translate to high effective interest rates. A business line of credit is typically cheaper than factoring, but it requires qualification and creates debt. Each of these tools has trade-offs. My suggestion, use the forecast to know your situation, then choose the tool that fits. If you can see a short gap 2 months out, a credit line might bridge it cheaply. If you've got chronic gaps, it's time to restructure your pricing or your terms. Sometimes the business model itself needs adjustment, not just the cash management. Here's what the best operators understand. Cash flow management isn't a crisis response. It's a competitive advantage. When you know your cash position weeks out, you negotiate differently. You spot opportunities that cash-strapped competitors miss. You take on projects with longer payment terms because you know you can float them. As the research consistently shows, this discipline of ongoing attention, not crisis management, separates businesses that thrive from those that survive. If you're finding this useful, consider hitting subscribe. We cover practical business signals like this every week, focused on what actually works at the small business scale. So, let's pull this together with your action items. First, build a 13-week rolling cash forecast this week. Open a spreadsheet or use your accounting software. List every expected inflow and outflow by week, then update it every Monday. Add the new week, remove the past one. Make it as automatic as checking email. Second, calculate your cash conversion cycle. Days inventory plus days sales outstanding minus days payable outstanding. Know your gap in actual days, not just a feeling. Third, set up automated invoice reminders in your accounting software. 7 days out, due date 7 past due, 14 past due. Takes 15 minutes to configure, works forever after. Fourth, have one conversation with your largest vendor about payment terms. Even a small extension creates breathing room. They may say no, but they probably won't, and the ask costs you nothing. Fifth, block 30 minutes this quarter to audit recurring charges, cancel what you don't use, move what you can to annual billing. Small savings compound when you're managing cash carefully. Remember, the goal isn't to eliminate the gap between earning and collecting. That gap exists in virtually every business. The goal is to see it clearly and manage it deliberately. Your P&L tells you one story. Your bank account tells another. The 13-week forecast helps you see both stories clearly and write a better ending. This is Small Business Signals. I'll see you next week with another signal worth watching. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making significant financial decisions.